There is a retired convenience store owner in North Carolina who did everything right for 22 years. He paid his taxes, he deposited his earnings, he kept his receipts. And then one morning he walked into his bank and his account was empty. Not drained by a thief, not touched by a scammer, seized by the federal government. Not because he committed a crime, because of the way he made his deposits. The pattern looked wrong to a machine, and that was enough. I want you to think about your own account right now. Think about the last 3 or 4 times you deposited cash. Think about the amounts. Think about the spacing. Think about whether you have ever adjusted a deposit, even slightly, to avoid paperwork or questions at the window. Because what I am about to share with you is information that a former IRS agent, someone who spent 30 years on the inside of this system, sat down and told me directly, off the record. The kind of conversation that does not happen in press releases or government websites. The kind of conversation that starts with the words, "Most people have no idea what we were actually looking for." My name is Zai, and a few months ago I sat across from a man who spent over 3 decades working inside the IRS enforcement infrastructure. I am not going to use his name. He asked me not to. But what he told me over the course of 2 hours changed the way I think about every deposit I have ever made, and I believe it will do the same for you. He described 4 specific deposit patterns that, in his words, light up the system like a Christmas tree. Not patterns used by criminals, patterns used by ordinary people, retirees, small business owners, families, who simply never knew the rules. He said, and I am quoting him directly, "We were not looking for criminals most of the time. We were looking for patterns. And the patterns we found most often belonged to people who thought they were being careful." That is what this video is about. The first pattern he described is called deposit fragmentation, and he said it was the single most common trigger he saw in his entire career. The logic behind it is intuitive, which is exactly why it is so dangerous. Most people believe that if they stay under $10,000 per deposit, no federal report gets filed, no one pays attention, and they remain invisible. That belief is not just wrong, it is the precise behavior the entire federal surveillance architecture was built to detect. Under Title 31 of the United States Code, Section 5324, deliberately breaking up deposits to avoid the $10,000 reporting threshold is a federal felony. The offense is called structuring. The maximum penalty is 5 years in federal prison and forfeiture of every dollar involved, regardless of whether the money is completely legal. It can be proceeds from a home sale. It can be an inheritance. It can be cash earned over decades running a legitimate business. The source does not matter. If the pattern suggests intent to avoid reporting, the law allows the government to seize the funds first and require you to prove your innocence afterward. The former agent told me something that stayed with me long after that conversation ended. He said, "I have sat across from people who were crying, people who had never been in trouble a day in their lives, and I had to explain to them that their money was gone because of a decision that felt, to them, like common sense." That is the cruelty of this law. The instinct that gets people caught is the instinct to be careful. What has made this exponentially more dangerous in recent years is not a change in the law. It is a change in the system's ability to see. For decades, bank compliance departments operated on rule-based software. If a deposit stayed under $10,000, the rule did not trigger. People discovered this, and the system had gaps large enough to exploit. That software no longer exists at any major financial institution. The banks are now running machine learning systems that analyze transaction behavior in real time and compare it against models built from billions of data points across the entire financial sector. The old system asked whether a transaction broke a rule. The new system asks whether your behavior looks normal. Those are entirely different questions, and the answer to the second one takes your complete financial history into account. A deposit of $9,000 from someone who has never deposited more than $2,000 in a single transaction does not need to match a rule to get flagged. It gets flagged because it does not look like you. The second pattern the former agent called temporal clustering. He said this was the one that most surprised people when he explained it, because it feels like the safe version of fragmentation. Here is how it works. You have $15,000 in cash, legal, documented, entirely yours. You decide to deposit it across 3 separate visits over the span of 10 or 12 days. $5,000 on Monday, $5,000 the following Thursday, $5,000 the Monday after that. In the old compliance system, those 3 transactions might have appeared as 3 unrelated, unremarkable events. In the current system, they are connected instantly through a technology called entity resolution. Entity resolution is an AI capability that links every transaction to your identity across accounts, branches, and in some cases, across multiple financial institutions simultaneously. Your 3 deposits do not look like 3 transactions to the system. They look like one $15,000 event that someone attempted to make invisible by fragmenting it across time, and the algorithm scores it accordingly. The Institute for Justice has documented dozens of cases where this exact pattern destroyed the financial lives of people who had broken no law. A family grocery store on Long Island had $446,000 seized because the owners made regular sub-$10,000 deposits to remain within their on-premises cash insurance limit. Their accountant traced every dollar back to a legitimate transaction. It did not matter. The pattern matched the model, and the money was gone for years. A dairy farming family in Maryland had $62,000 taken because a bank employee had advised them that smaller deposits meant less paperwork. The government initially forced them to surrender nearly $30,000 of their own money in a settlement before congressional pressure compelled the IRS to return the full amount. In every one of these cases, the underlying funds were entirely legitimate. The only thing that triggered the seizure was the pattern. The third pattern is what the former agent called a velocity break, and he said this one catches retirees in a way that is particularly difficult to defend because it happens at the exact moment their financial life is changing for entirely legitimate reasons. Your bank's compliance software builds a behavioral baseline for every account it holds. It knows your typical deposit frequency, it knows your standard transaction size, it knows your usual withdrawal amounts. If you have maintained a consistent pattern for years and that pattern suddenly changes, the system flags the deviation, not the amount, the change itself. He told me about cases where a retiree who had maintained the same account behavior for 15 years tried to help an adult child with a down payment and was immediately placed under compliance review. The money was legal, the documentation was clean, but the withdrawal was larger than anything in the account's history. It was the first interstate wire the customer had ever initiated, and it happened within a compressed time window. Every one of those factors scored simultaneously. A suspicious activity report was filed. That report entered a federal database and will be cross-referenced against every transaction that account holder makes for the next 5 years. She did nothing wrong. That is the part the former agent kept coming back to. He said, "The system is not designed to establish guilt. It is designed to flag deviation. Guilt or innocence is someone else's problem to sort out later." The fourth pattern is the one that generates the most disbelief when I describe it, because it sounds completely harmless. The former agent called it third-party deposit involvement. It refers to any situation in which someone other than the account holder makes a cash deposit into the account. Your son deposits money into your account while you are out of town. Your business associate drops off the week's earnings at your branch. A neighbor does you a favor and runs to the bank with an envelope of cash. In anti-money laundering terminology, this behavior pattern is classified as Smurfing, and it is one of the highest priority flags in the entire detection architecture. He said it plainly. When we saw third-party cash deposits, the review was automatic, no exceptions. The system does not know your son, it does not know your business associate, it does not know your neighbor. It sees an unidentified individual depositing cash into your account, and it treats that as a potential attempt to conceal the origin of funds. The compliance officer who reviews the flag does not need to conclude that you did anything wrong. The algorithm triggered and the report gets filed, and you will never be told it happened. That last point is what the former agent said kept him up at night, even years after leaving the agency. Under federal law, 31 USC section 5318, it is a crime for a bank employee to inform you that a suspicious activity report has been filed on your account. The teller cannot tell you. Your banker cannot warn you. The branch manager who sat across from you and asked you 3 questions about a withdrawal cannot say a word about what happens next. You could be in that database right now. You could have been entered into it last year. In 2025 alone, banks filed over 4 million suspicious activity reports, 11,000 per day, each one feeding directly into a federal database shared between the IRS Criminal Investigation Division, the Drug Enforcement Administration, the Department of Homeland Security, and approximately 400 other agencies at the federal, state, and local level. Once your name is in that database, it remains there for 5 years, and every transaction you make during those 5 years is automatically cross-referenced against the original flag. Now, I want to give you the protection side of this conversation, because the former agent spent the last 30 minutes of our conversation on exactly this. He said, if people just understood 4 simple rules, 90% of the cases I worked on would never have happened. The first rule is the one he called the most important and the most counterintuitive. Deposit the full amount in one transaction. If you have $14,000 from selling a vehicle, deposit $14,000. If you have $25,000 from an estate distribution, deposit $25,000. A currency transaction report will be filed. He was emphatic about this. That report is not the threat. That report is your protection. When the bank has documentation showing you deposited the complete amount in a single transparent transaction, there is no pattern to analyze and no investigation to initiate. The report is the end of the story. The people who split the deposit to avoid the report are the ones who create the pattern that opens an investigation that could have been prevented by doing nothing more than making one complete deposit. The second rule is documentation prepared before you reach the bank window. For a vehicle sale, bring the bill of sale with both parties' names, the date, the amount, and signatures. For a gift, have the giver write a brief letter confirming the amount and the fact that no repayment is expected. For an inheritance, bring the executor letter or estate settlement documentation. He said, I cannot tell you how many cases I reviewed where a single piece of paper would have closed the file in 20 minutes. The documentation does not just protect you legally, it removes the question that the compliance officer is trained to ask. No question, no flag. No flag, no report. The third rule is to contact your branch before a large deposit arrives. If you know a required minimum distribution, a pension lump sum, a life insurance benefit, or a survivor payout is coming, call the branch manager. Ask them to note the expected deposit in your account profile. That note changes the context for the compliance software. The former agent said, "Context is everything in this system. The same deposit that triggers a review in one account will clear automatically in another because one account has documentation and the other does not. You are not hiding anything. You are giving the system the information it needs to not flag you." The fourth rule is to route large, irregular deposits through the right type of account. Retail bank checking and savings accounts run the most sensitive compliance algorithms in the financial system. Brokerage accounts at established investment firms are built to handle large transactions and operate under materially different monitoring standards. If you are expecting a lump sum of any significant size, have it routed to a brokerage account rather than to your local branch checking account. Everything reportable still gets reported, but the likelihood of a suspicious activity report being added on top of the required filing drops considerably when the receiving institution treats large transactions as routine. The former agent ended our conversation with something I have been thinking about ever since. He said, "The system was built to catch criminals, but criminals learned it faster than ordinary people did. So the system started catching ordinary people instead." The four patterns I described, fragmentation, temporal clustering, velocity breaks, and third-party deposits, are not the habits of criminals. They are the habits of people trying to be careful with money they earned honestly. And that is exactly why those four patterns are the ones the system is calibrated to find. The report is not the crime. The crime is trying to avoid the report. If you have ever split a deposit, if you have ever asked someone to run to the bank on your behalf, if you have ever moved money in a way that felt careful, but that you could not fully explain, this video was for you. Share it with someone who needs to hear it before they find out the hard way.